Thank you all for coming. This is the last investor evening of 2019. My name is Phil Thomas. I'm the founder of London South East, LSE.co.uk. Thank you for those of you that use us already and have been to these events before. A couple of thank yous. Quick thank you to City Index, who are our sponsor tonight. It should go. Today we launched our cryptocurrency section on LSE.co.uk. Which has been well received, and I've been asked to point out that City Index are actually, I have a phrase here which I must read because it's I'll get it wrong, but they offer the lowest costs on your spread betting and CFD crypto trading. So there, I've delivered that phrase. So if you are looking to get involved in that space, they're a good go-to. Some thank yous to our speakers tonight as well. We've got Matt on first. I'm not going to introduce all the speakers because that's Nigel's job. But we've got some great speakers on mostly all oil and gas, and I know that's who you're here to see. So I will, no further ado, pass over to Nigel.
Thank you. Thank you very much indeed, Phil, and good evening to everybody. I'm intrigued to know, or just to think how they're going to refurbish the Brewers Hall. If it's like a sort of an old Weatherspoons at the moment, what's it going to look like when they've done it up? So that should be fascinating. But yes, it's our last event of the season. I hope you're going to enjoy it. I think we can see from our attendance here, hardly a spare seat. This is a very popular sector with LSE customers, so that's all good. Just a few fire safety mentions. As always, those of you who've been here before, there are exits this end and this end, so if you just make your way outside and we gather on the square, hopefully you won't need that information. We are recording this event as we always do, so if you miss any of it or if you want to check what any of the speakers said, tell your friends. If they're interested in oil and gas too, then please beware, you might just be caught on film, so if you are here with somebody you shouldn't be, well, you've been warned. The other point to make is that, as always, Donald can cross the conference room in seconds. We'll be running around with the microphones, and just so that everybody can hear what's going on, if you could identify yourself if you can, or at least wait for the microphone before you ask your question. For our speakers, hopefully we always get some great questions. So that's coming up after each speaker. And I know that you were dragooned into taking a questionnaire on your way in. If you can, just find a bit of time to fill it in, that'll be great. It gives us really good feedback. It helps us to improve these events, gives the companies also a bit of feedback on what investors are thinking about what they're up to. So I think it's jolly useful all round. So we've got a really promising array of companies and a really varied array of companies too on parade tonight, with Coro Energy, Petro Matad and Eco Atlantic waiting in the wings. But we're going to start with Nostra Terra, or NTOG, which of course is its stock quote on AIM, a company focused on the prolific Permian Basin in West Texas. We've got the chief with us. He's got a wide experience of business development in energy and real estate and the communications sector. He launched several divisions with Robson Energy. His qualifications include, now this intrigued me, including a global MBA from the Thunderbird School of Global Management. Well, I just wonder if he knows Lady Penelope and he's ever been to Tracy Island. Maybe we'll find out. So here we are, Matt Lofgran, the chief of Nostra Terra.
Everybody, first off, I want to thank you for taking the time out of your day to get to come here, or your evening. I appreciate that. If there's any questions along the way, if it's all right, I'm happy to take the questions as you have them. If you want to save them for the end, that's fine as well. Disclaimer, I'll leave this. It's going to be on our website. It's also in the presentations that you have. So a lot of this, I'm not going to be reading through the slides, but you'll have access to it when you want. So the opportunity here at Nostra Terra, I want to point out, first off, our market cap, we're very small right now. Our market cap's about 3-4 million sterling. Closed today, I think we're about 3 million sterling. And if you look at our assets, we've got and this is just our reserves. We'll get into the details here in a moment. Our foundation of our assets, we've got proven producing fields, proven producing reserves, and then we also have some speculation, if you will, some assets that haven't been drilled to add additional upside. So our proven reserves, you're looking at 760,000 barrels, future net income of approximately $15 million, and PV9 of that at $7.5 million. Total 2P, including the expansion of the Mesquite asset that we had recently acquired, takes us to about 2.5 million barrels of reserves, 2P reserves, proven and probable. $59 million of future net income, and PV9 of $24 million. We've got 2 new wells that we're permitting right now that we'll plan on drilling here shortly after getting those permits. Something else I want to point out is on these reserves, there's a little footnote here, as small as it is, it's important. The reserves were done, they were performed by a third-party engineer that works for the bank. We have a senior lending facility with the bank. It's a very good facility I'll touch on. And that is done by a third party, and at the end of the presentation in the appendix, there's also the price deck. So in addition to being conservative in the various areas of how the assets are operating or how they anticipate they'll operate, we've also used a price deck where you're looking at about $50, $51 oil prices. So the figures that we have here, we believe are relatively conservative. Specifically, something that I think is important to understand is the proven resources we are producing already. So on something like that, I like to look at the future net income because we are receiving revenue every day, every month, every year. We've been producing these assets. We know what they do. We take that money in. We make money in the field. That goes to the PLC cost. So these are pretty strong figures, we believe. Who we are as a company, we're focused on onshore U.S. We want jurisdictions that are safe. We want something that's low risk for political risk, low risk geologically, and we have that in the U.S. It's one of the lowest risk political risks around. On geological risk, we're in proven producing basins. So we're in fields that have already been drilled up. We have wells that are already producing, as I said, but we also are going to drill new wells around in these producing fields. So this is not rank wildcat. There's no exploration involved. It's proven, everything that we're doing. The foundation of the assets in Texas, most everything, actually all of our assets at this point are in Texas. They're conventional reservoirs, they're not unconventional, so these have shallower declines, they're more predictable. We're 100% oil right now. And as I mentioned, we have a senior lending facility at 5% interest rate. So the bank, as I mentioned, they have a reservoir engineer on staff who assesses our reserves. They get into every single well, they look at the declines, they look at the operating costs, production on every single well. They look at our overheads on running everything in the field as well as in the office, and to come up with their valuation on that. To do that, they're giving us a 5% interest rate. It's one of the better facilities around. It's not something that you often see in oil and gas, and especially in the exploration, because you can't get debt like that on exploration. Okay. You also can't get debt in a lot of foreign jurisdictions if you don't have that predictability, the ability to collect these revenues, the ability to get all that in. So this says something. It speaks to the quality of our assets as far as the bank wanting to see that production, they want to see that profit, and they want to see the management team that can handle that, hence the reason why we got the facility. Our board is 3 directors. Our chairman is in the back of the room. If there's any questions, any conversation later, he's available. He's always happy to talk about the company. So I'll talk about him for just a moment. Ewan joined the company a couple of years ago. As I mentioned, we're very small. During the downturn, we repositioned the company. We've been repositioning the assets when oil prices had dropped significantly. We also wanted to reposition the board and strengthen our board with the ambition that we have as a company. Ewan has experience in being involved in companies in an early stage and seeing them through to becoming a much larger companies. Most recently, he was the CFO of Gulf Keystone, where he was, again, one of the early stage employees there, helped get the company pre-production, pre-discovery to the point where they were multiples of where they were. Helping raise over $1 billion debt and equity for the company. So that's the kind of experience that we had brought to the board to help us as we grow going forward. We've also brought on John Stafford. John had joined Gulf Keystone as well, early stages. He was the 4th in the technical team. Then he led the technical team to the point where there were over 12 senior staff in the technical team alone, 300 people in operations that he led. So starting from a small company, growing that into something more substantial. Again, that's why we brought Ewan and John onto the board. The assets in the U.S., as I said, we're focused in Texas right now. Most of our experience is mid-continent U.S., so that's going to include Oklahoma, Kansas, Colorado, even into Wyoming, a little bit of Louisiana as well. But the assets are in Texas, and we're on both sides of Texas, in the East Texas oil field with Pine Mills, West Texas, and the Permian Basin. Something that I think is pretty interesting when you look at this, you look at the blue outline, the thin blue outline there, that's the extent of the Permian Basin. And what we did was we overlaid the UK to get an idea of how big the Permian Basin is. So if you want to try and compare the Permian Basin to, say, the Wild or the Wessex Basin, or to the North Sea for that matter, size-wise, the Permian Basin covers all of it. Well, we've got a portion of that. It's a very active area. Now, you're only looking at the aerial extent here. The other thing to keep in mind is that you have a lot of different formations. We call them stacked pay. So if you think about pancakes, I know that's not the breakfast of choice here, but stacked pancakes, and each of these is a formation, an oil or gas-prone formation, that you can drill horizontal wells into these formations, all from the same pad, and have wells. You can have up to a dozen different wells in some cases, because they're all very prolific. That's why there's been so much activity that's gone into the Permian Basin recently. It's the most active oil field right now. BP is the one that made the most news over here when they spent $10.5 billion in the last couple of years to buy into the Permian Basin. Now that's them getting a position that they expect, that they plan to grow, $10.5 billion on the acquisition alone. Another company that had gone in and done that is Concho Resources. Concho was already in the Permian Basin. It's a company I would guess that nobody in this room has heard of before. Concho, market cap of $30 billion. So bigger than most of the companies, bigger than most oil and gas companies in London. And the reason I'm mentioning Concho, with a $9.5 billion acquisition they did recently to expand, one of the co-founders of Concho, VP of Exploration for Concho, had created Trey Resources. He left Concho and created Trey, and Trey is who we brought on to help us with the field development plan of one of our assets. So the name of the game for these companies in the Permian is going into these existing fields that have vertical wells all around. They've been drilled for years, for decades, and taking them horizontal, doing the horizontal wells, introducing modern technology to these fields so you can extract a lot more oil. And that's where Concho had grown to be a $30 billion company. That's why BP had bought in, and that's why we've engaged Trey again. So now on to the more specifics on the assets, starting over in East Texas and Pine Mills. Pine Mills is something that we own 100% of. We operate it. There were 3 previous operators, 3 previous years, all lost money. We took over operations. Within the first month, we turned it to be profitable. We've made money since we bought that. Okay, we're doing pretty good with that field. So far, what we've done is mostly workovers and reactivations. We have not drilled a new well. In the last period, 2018 to 2019, mid-year, we actually increased production without drilling a new well. That's not an easy thing to do. So we manage our costs pretty well. The upside that we have there that we haven't exploited yet is some of the bypass pay. And that's something that we have available for later. Our licenses, or our leases in the US, are held by production. Because we're already producing, there's no risk of expiration of these leases. So we can go and get the bypass pay later. So that's banked, if you will. And we're saving that for a future time, where it allows us to put our money into focusing, growing that foundation a little bit further before we grow Pine Mills. Here's a separate slide, talks about the valuation, our reserves. Touched about this on the beginning, and I'll hit it at the end as well. Into the Permian Basin, there's 3 acquisitions we did in the Permian Basin during the downturn. We were able to do some acquisitions of just a few barrels a day. It's nothing exciting. It wasn't meant to be exciting for that reason. But what we did when we acquired this was we acquired the ability, these other locations that had not been drilled yet. And again, because these wells were already producing, the other wells, doing a few barrels a day, that allowed us to hold those leases in perpetuity without any risk of expiration. So when we did that, we banked those locations for the future. We ended up drilling later. I want to point this out. These are the 3 areas, the darker colors here. And this area here is where we drilled the twin well. Every one of these are wells. This is a square mile. Each of these squares is 1 square mile. I guess you could fit the city in there, I suppose. In an area like this is one well every 40 acres. So the idea is that each well is going to drain that area, and that's what it takes is the 40-acre spacing. Until somebody says, well, wait a sec, if we drill a little bit closer than that, we still have a good well. It hasn't jeopardized the wells next to us. These new wells are coming on strong. That tells us that the 40-acre spacing didn't drain that reservoir either. So let's go tighter spacing. Then the wells in the middle here in this swath, these are mostly on 10-acre spacing. So it starts to come to the point where you say, well, wait a sec, if you're drilling this many vertical wells, what about just drilling one horizontal well and getting after all of the reserve that's there? And of course, a horizontal well is more expensive than a vertical well, but how many vertical wells to a horizontal well? And that's where it comes down to the economics and the development plan on which one is more effective. So we drilled a vertical well shortly after we acquired this. Oil prices during the time that we had drilled were about $50, $60, and we got payback on that in just under a year. That's not an easy feat to do. At $100 oil prices, most companies don't do it. It takes closer to 3 years. We were able to get payback of that, all of our investment back in just under a year on a vertical well. So what happens if you were to go into a field like this and now start doing some horizontal wells? It gets even more exciting. So again, these are something that we have more of these locations that are banked, these locations that we can drill in the future. But it shows that we were able to pick good locations to drill, that we can drill, we can make money, and we can do this in the current oil price environment. We don't have to wait for higher oil prices. I'll just point something out on here on the photo. If you look at the tan areas, each of those tan areas is a well that's producing. This isn't the most pronouncing one of the pictures, but it does give you an idea. These go on and on and on. There's wells everywhere. On to Mesquite, we went and acquired into another area that's been old producing area, been producing for some time, a lot of vertical wells that have been drilled, but the rock looks to be the type, it's a tighter rock, where it makes sense to do horizontal drilling. And that's what we felt. Trey Resources actually felt that as well separately, part of why we had engaged them. We acquired the Mesquite asset from Tall City. We did that about a year ago. We engaged Trey Resources and to do the field development plan on what it looks like to do horizontal wells. So the area in yellow are the areas that we have leases on currently. We do plan on expanding that position further, but we can drill 4 wells right through the middle of that right now. If we add or to drill shorter laterals or all of our acreage, it ends up being effectively net 8 wells that we can drill. It's pretty exciting, again, when you look at our current production versus what these add on future production and reserves. One other thing I actually want to point out before we move on, if we were to drill vertical wells instead of horizontal wells, then these are all proven reserves. The engineers have already looked at this and say, you're surrounded by production. How far is the closest discovery? Somebody had asked me at one point. There's no discovery that's so many miles away. We're in the middle of producing assets. We're long past discovery. So we're a mile away from production on one side, 2 sides, 3, all 4 sides, we're surrounded by this production. So there's no question if the oil is there. We know that the oil is there. It doesn't disappear for 1 mile and then pick up again. The question, again, comes down to the economics on what are these economics on drilling a horizontal well as opposed to a vertical well. Just a quick image to give you an idea of what it looks like. The reason why you do the horizontal drilling, if you think about when people drill a vertical well, they don't always hit. Sometimes you can drill a well and it ends up being a gusher. You drill an offset well to that and it's a duster. And it could be vice versa. It happens all the time. The reservoir, the oil is not a pool under the ground. It's not sitting there in a pool. It's in different pockets. It's reservoirs like this. So the idea on a horizontal well is intersecting, connecting as many of these reservoirs as possible. And that's why you do that. I won't go into detail on this, but these are the more of the economics on a single well with a 1 mile lateral. But I will point out that at $60 oil prices, you're a 44% IRR. That's pretty strong at current oil prices. So looking forward, the things that we're going for, that we're aiming to do, are 2 main milestones that are ahead of us: profitability on the PLC level, and after that, paying a dividend. We do want to seek towards getting to the point where we're paying a dividend to shareholders. Our growth is going to come in two different ways. It's going to be from drilling on our existing assets. We had just acquired 160 acres in this area, in the Mesquite area, an additional 160 acres, a little square mile, production on all four sides surrounded by it. And we were able to find this little lease and pick it up from, ended up being 17 different family members. So we spent the time to do that, track them down and get that. Now we're able to drill 2 half-mile laterals in there, 2 half-mile wells in this particular area. So we're permitting one of those, and we're permitting one of the other 1-mile laterals. So our growth will come from drilling these new wells on our existing assets, but it'll also come from acquisitions. With our senior facility, the senior facility that they lend to us, that goes based off of our existing production. But if we were to acquire an asset, that's there to leverage out as well. So the facility is a $5 million facility. We currently have a borrowing base just under $2 million. But the 5 million, the 2 million figures are mostly irrelevant. If we have an asset that we put in front of them, let's say it's a $20 million asset. If that's the case, they're going to assess it. They're going to have the engineer go through and look at those reserves, look at the cash flow on that, and we can borrow according to that. So then the size, the 5 million, will now increase. So it is there for us to leverage. Washington Federal is the bank who's given us the facility. They're not in the business of they're not making much money on a small $5 million facility, $2 million borrowing base at 5%. They partnered with us. They're working with us because they see what we're planning as a company. They want to grow with us. So in closing, our reserves are rather significant compared to where we are on market cap. Future net income, $58 million based off of lower oil prices, $24 million in PV9. And want to point out that we have the ability to acquire assets. We've proven that we can do that. We can acquire assets that make money, that are already producing and making money. We also can operate profitably. We know how to operate a very good team out in the field. We can drill wells in the lower oil price environment and make money. We can pick the right locations and we can drill those effectively. And we know how to manage our overheads prudently. So the next thing for us is that scale. The focus is now getting us the scale so we can grow much quicker.
Thank you very much indeed, Matt. Okay, well, you all politely left your questions to the end, so we can take a few questions for Matt now. So who wants to be first? Okay, well, while you're thinking about that, let me just ask you, I mean, the company's been going since, is it 2005, 2006? What is the nature of the change in the company? How would you say you're different now to when you started out? You did touch on this.
Mm-hmm. So when the company started, I wasn't at the company in the beginning, by the way, but when the company started, it was because of the excitement after the Velvet Revolution in Ukraine. People got excited to go invest in Ukraine. And they had raised some money and invested in Ukraine and had a field down in the Crimea. And it didn't work out for various reasons. I'm happy to talk at length, but I think most people know
that gives us a start. Yeah. Thank you. There's a question at the back here.
In your modelling, how much do you think these horizontal wells are going to cost, and what kind of production do you think you are likely to get from them, and what kind of decline rates?
Mm-hmm. So we've touched on two different types of horizontal wells. We call it a 1 mile lateral and a half-mile lateral. They will be shorter than that, but those refer to the length that you could, if the full extent of that lease. But you actually have to drill a little bit shorter to be within those lease lines. So that's how they're affectionately known, but they will be shorter. The half-mile lateral is approximately $1.8 million, and the 1 mile lateral is approximately $2.9 million. Production was the next question. IP rate, and I want to caution you on IP rate, and I'll get to that in a moment, but IP rate at about 265 barrels a day on the 1 mile lateral. On the shorter one, we haven't published that yet, so I'll hold back on referring to that. But what's more important is not the IP rate. The IP, the initial production rate, is a very misleading figure. And I think it's very, very important. If there's a key takeaway for the whole industry when you're looking to invest, please understand that IP rates are not what you should be looking at. people like to get excited about that, and they multiply it by 365 and start counting their dollars, and it doesn't work that way. Wells are going to decline. That's what they do. It's like opening a soda can, and the moment you open it, that fizz comes on and then drops. So the wells will come on, and they will come on strong, and then they will decline. The more important figure I think that people should be looking at are the EUR, the estimated ultimate recovery, how much is recovered, and then you factor in the declines. So you've asked the question kind of covering all the basis there. If you factor all that in, that's what a reservoir engineer does to come up with what the value of that asset is compared to the investment. And we've got this slide in there that covers every bit of that in the presentation as well. Okay?
Any more questions? Yes, got a question at the front here.
Just very quickly.
Sure.
Just wait for the mic. There you go.
Having invested in NTOG some years ago and pulled out just before I lost any money, why should I invest in you now? Because I don't see much of an impact, really. Mm-hmm. I mean, with everything you've said and everything, all the drills you've done and everything, I hardly see anything that excites me right now.
Mm-hmm. Yeah, I understand.
Why should I invest in you now?
So first off, if you look at the companies that have been around during this time, when the oil prices dropped, there's a saying, in strong winds, all wild turkeys fly. It's a lot easier at $100 oil prices, but when oil prices dropped, if you look at most of the companies that are in the U.S., they're not here today. Okay, they were sitting there doing RNS after RNS about a forbearance agreement, defaults on their loans, all these problems. We never announced anything like that because we didn't have that problem, and we faced that. We did have to get through that. It was not an easy time. But when oil prices dropped, companies have gone under, and they're still going under today, even after oil prices have recovered. They're still filing bankruptcy, still distressed, still having problems. So there's not going to be a lot of growth during that time. We did everything we could to stay alive. And as I said in the beginning, we've repositioned our portfolio. We went from assets that we weren't operating, we didn't have control over timing and how the wells were drilled, when they were drilled, et cetera. We went from that repositioning to where we've got total control over our portfolio, and in conventional reservoirs where the declines are smaller or shallower, frankly. So we've done that. As I've said, we've also repositioned our board. And now that we're at that point, now we're going for scale. Now, we haven't drilled a lot of wells recently. We drilled the twin well and the G6 well. And as I said, the twin well had hit payout in less than a year. That's pretty remarkable. But in the current oil price environment and the way the markets are, it's not getting as much attention. We're still subscale, and that's been the biggest issue. So our drive is to get out of that subscale right now with larger wells, larger acquisitions. The Mesquite asset offers that ability with the wells. The single well can have a huge impact on the company.
So over the years, you've had quite a few raises, consolidation, dilution, whatever. Mm-hmm. Where are we? You're at 190 million shares right now. Am I right? Something like that, according to
close to 200, 190.
Okay, whatever.
Yes.
Okay. So I presume, how are you doing for funds at the moment? Or will you be raising more money through more dilution?
We're okay for funds. Going forward, we'll always have a combination of debt and equity. Mm-hmm. As I said, we have a senior facility with Washington Federal that allows us to grow. And again, banks are not giving those out if you're not making money. Mm-hmm. So we've proven that we can do that. We will have a combination, though, of debt and equity going forward.
Okay, well, thank you very much indeed. I think that's it. Thank you very much indeed to Matt. Okay, well, next, a Southeast Asian-focused exploration and production company, one which is not short of news flow or indeed gas flows. Come to that. Last year, it took on teams and assets from what were Sea Hill and Saffron Energy. We've got the CFO here tonight. He's got years of experience unlocking growth across AIM companies. He's a corporate financier. He's been an investment manager. So will you welcome Andrew?
So first and foremost, we have our disclaimer here. So those of you who've got access to the presentation, please take your time just to understand the context in which this presentation is giving you tonight. We're going to talk through a brief introduction of Coro for those of you who don't know who we are. Then we'll touch through the Do Young PSC, those who do know who we are will know that we're actively drilling at the moment there. And then we'll touch on the Bulu PSC and Block 2A, which we have in Malaysia, before wrapping up with a bit of an overview of Southeast Asia and the current E&P landscape. So first and foremost, for those of you who don't know us, Coro is an upstream oil and gas exploration and production company focused on growing in Southeast Asia. The company admitted to trading in April of last year on the consolidation of 2 small Italian portfolios, as well as the introduction of £14 million of new equity at spot price, alongside which we introduced Lombard Odier Asset Management as a shareholder who took 16% of our business at that stage, and CIP Merchant Capital who took a 20% stake in our business. Since then, the share register has turned over. Lombard Odier today now own just shy of 25% of our equity, and CIP Merchant Capital remain with their original position of 21%. Conrad Petroleum, who's the operator on the Du Young PSC, owns 7% of our equity. Directors own just circa shy of 2% of the equity, and the balance is held with retail investors. In March of this year, we raised 22.5 million euros by way of we issued a 22.5 million euro bond. Half of that euro bond was subscribed for by Lombard Odier. A quarter of it was subscribed for by CIP, so continuing to support the company, and other institutional investors took the balance. That financing was to allow us to acquire and fund the Du Young PSC. Our CEO is James Menzies. Those of you who are long in the tooth in oil and gas investing here in London will remember that name. He was the CEO of Salamander Energy, which was a main market listed E&P company focused on Southeast Asia. That's a company he co-founded around his kitchen table back in 2004, grew to a company of producing 20,000 barrels of oil a day before it was acquired by Offshore Energy in a deal of 850 million enterprise value at the back end of 2014, beginning of 2015, as the oil price was coming off. James is a geologist by background, and a very tenacious business development man, I must say. So he knows the patch like the back of his hand and has been instrumental in us getting the traction that we found within our first 18 months of admitting to trading. So as a company, we released our interims last month. You would have seen there's 11.5 million cash in the bank as of June. Net debt circa 7 million, and today we currently have a market cap of 20 million. We are a tenacious company. We've done 3 transactions in our first 18 months. We've massively transformed the balance sheet of the vehicle that we're in charge of. And that's a very important point I would like you to note, is that we are a business development company as well as an E&P. So we have 3 transactions that we've done to date. We'd like to see another 3 in the next 18 to 24 months as well. And then we would have hopefully a broad portfolio of production and development as well as exploration for a blended mix. So first and foremost, let's go on to the Du Young PSC in Indonesia. So this is a transaction we announced in Q1 of this year. We acquired a 15% interest in the Du Young PSC, which is in the West Natuna Basin, offshore Malaysia, but in Indonesian territorial waters. Now, the West Natuna Basin has been a strong producer for Indonesia and indeed supplying to Singapore. So there is a very strong infrastructure in place. The basin's been producing for 20 years now, so that infrastructure the basin is now in decline, so there's ullage within that pipeline infrastructure that will be valuable for us to market and commercialise this gas. So we're 440 kilometres away from Singapore, where we have an MOU signed with a gas buyer. We have a plan of development which is approved by the Indonesian authorities. And most recently, we have drilled an appraisal well in the Mako gas field, and we're currently drilling an appraisal and exploration well, which we'll touch on as well. Now, the field itself is quite a large aerial extent. It covers approximately 350 kilometres squared, but it's shallow gas. It's circa 400 metres below the mud line. We've had 4 wells that have penetrated the field to date, and they've all found gas. And obviously, we're putting another 2, or we're 5 now, and hopefully 6 by the end of the month. Now, the reservoir has been cored and tested, and most importantly, flowed commercially at 10.8 million scuffs a day. So we have a resource here of 276 BCF on the 2C case, which is what we acquired as part of the transaction, and we've identified that as a commercial resource in itself. We drilled the Tambak 2 appraisal well in the last couple of weeks, which was a 13 which was a 13.5-kilometre step out from the original gas discovery, which was the Mako South 1 well. So that's a huge, large step out, and we had a successful appraisal with finding gas. The key risks of that drill was the quality of the reservoir, which we have obviously de-risked with finding 33-foot sandstone there as opposed to the 24-foot that we had at the Mako South well from 2017. The issue that we came across was, unfortunately, we failed with the DST, the drill stem test. That was unfortunate because it was a nice to have, but it was unfortunate because the market lives and dies by it. So the key risk of the original Tambak 2 well was the quality of the reservoir, which is why the DST was in our work program. But actually the results of that were that the reservoir there is better than the Mako South 1 well. We did an open hole test, and the consequence of that was we had a faulty packer. So we had an operational issue here, not an issue with the rocks. So when they pulled out, they swabbed the well, and we ended up flowing gas uncontrolled. So when that happens, you're 400 kilometers offshore, you have to control that well, and it's 60 barrels of kilnwood ended up going down there, which ultimately ended up plugging and abandoning the well. Now this well was never intended to be a producer, so it was always going to be plugged and abandoned, but the consequence of that is we didn't get the DST result that was originally in the program. It was originally in the program, as I say, because the quality of the reservoir was the main risk on this particular well, but we proved that the reservoir had better quality than anticipated, and we achieved all the other objectives. And the DST became nice to have because we already have that data from the original Mako South 1 well. So moving on, we're now currently drilling the Tambak 1 well. Sorry, the naming convention's reversed there. So we're drilling Tambak 1 now. Tambak 1 is a 4.5-kilometre step out from the original Mako South 1 well to the northeast. And the principal objectives of this are twofold. One, we want to appraise the Mako gas field. And ideally, we want to see the gas-water contact there, and we want to see gas on water to appraise the limits of the field. But then we'll be deepening that well, and we'll be testing a 250 BCF mid-case prospect that we have a 45% chance of technical success. With regards to the appraisal of the field, that is happening now. So we're drilling it currently at the moment, and we hope to be able to update the market at some stage, maybe towards the back end of this week, with regards to what we're seeing there. The intent of this is to increase the resource size that we have in the Mako field. So internal estimates or management estimates believe that we can convert 100 BCF of 3C resource into the 2C case here. Now we've appraised this field, and our analysis is that this is commercial at 276 BCF resource. But if we can convert that 3C number to 2C and some 2C to 1C on the back of the 13.5-kilometre step out and a 4.5-kilometre step out, then we're flowing extra gas through a model that we've already appraised as commercial, and that we can achieve all of that production from the same POD, which has already been approved by the Indonesian authorities. So that really is extra cream for us to be able to monetize. Now we will deepen the well, and we will be testing this 250 BCF prospect, which is in the Lower Gabus. Now this is the main area in which people are exploring in this basin. There have been drills either side of this well, here and here, which did come in dry. Now, what you will also see is that on we have a seismic response within this structure here, which didn't exist in the other two, which has led us to the 45% chance of technical success. Now, what I must stress to you all is that this is, again, a very nice to have opportunity for us. This is relatively low risk exploration, but the incremental cost of us to test this prospect is only the marginal extra couple of 100 meters beneath the main horizon of the Mako field, which we want to appraise anyway. If this was to come in, we have the opportunity of converting a resource size into something near a 600 BCF, which is very strong currency for us in terms of the negotiations with Singapore buyers. Singapore imports all of its gas, and a consequence of that is they want surety of supply. So bizarrely, they will pay a premium price for a bigger resource than if you have a smaller quantity to sell into their market. So this is very valuable for us in terms of those negotiations, which will be continuing following the results of the current drilling campaign. However, if this doesn't come in, what we still do have is a field by which at least there's 276 BCF, and as a consequence of the Tambak 2 well we've drilled, we expect to be near 370 BCF on the CPR upgrade. So this wouldn't be an asset killer if the exploration didn't come in. It very much is a nice to have. We would obviously like it to be successful, but the monetary value of this gas is slightly less valuable to us than the increase in the resource size in the Mako field, because extra infrastructure would need to be put in place in order to monetize the gas that we find there. But overall, we have a field here which is commercial. We have appraised 13.5 kilometre step out, which will be significant impact for our CPR. And most importantly, we are adjacent to the West Natuna transportation system, which is the big gas pipeline infrastructure that goes from this basin all the way through Indonesia and supplies gas to Singapore en route as well. As I say, we have a HOA signed with Sembcorp, who's a gas buyer in Singapore, and that's a premium market, $8 to $11 per MMBTU gas price. So very lucrative market. And for the development costs of this project, a gas sales agreement signed with a Singapore buyer is credentialized with the bank, so very bankable in terms of getting the development funding that we need. So we're currently drilling at the moment. We are expecting results in terms of the appraisal of the Mako imminently, and then there will be a deepening of that well to test that Tambak prospect, and perhaps maybe that will be some news flow that we might be able to produce for the market at some stage next week. So it's all going on at the moment in Indonesia for us on the Du Young PSC. And the CPR upgrade we'd hope to be able to deliver to you early in the next year, early in the new year. The first transaction that we did in Indonesia was acquire a 42.5% interest in the Bulu PSC, which is in East Java. This contains the Lengo gas field, which is 359 BCF of 2C recoverable resource. The gas accumulation lights up on seismic, as you can see in the top right of the slide here. We have a well-developed reservoir over 80-metre column height, and we've successfully appraised and flow tested and cored it. So the two wells that have gone into this gas accumulation flow tested at 12.9 and 21 million scuffs per day, respectively. So very commercial flow rates. We have an approved plan of development again here with the Indonesian government, Indonesian authorities. And the current activity that that's happening on this license is gas marketing. So there's multiple buyers for gas in East Java. It's a very industrial area. There are negotiations that are steered by the Indonesian authorities that are going on now. There's always a conversation to be had with regards to price. But the main issues for us here is actually identifying the right buyer and working with the government, because there are such a number of different requirements for this gas. So expect to see here, perhaps maybe get the first gas sales agreement signed by hopefully the end of the calendar year. If not, we would expect some stage in Q1. And from there on in, we can take FID on the project and then move it forward towards commercialization and start flowing gas, hopefully by the back end of 2021. As we spoke about, we've got a shallow carbonate reservoir here, so it really does light up on seismic, so it's very well defined. The gas itself is 67% methane, so it does have 12% CO2. What that will mean is that we will be required to build a carbon steel line pipe to bring the gas back on shore, which is 64 kilometres. We will remove the CO2, and then we'll be able to sell the gas to the gas buyers that we are communicating with at the moment. So, a relatively simple project here insofar as we have a gas resource, we have a multiple number of gas buyers. There needs to be the gas sales agreement negotiations. Once that's delineated, and they're fixed price gas contract, so we wouldn't be subject to any market volatility in the commodity prices. We can then move to FID, develop this, which will be gross project of 200 to 250 million. And then this asset is expected to be producing for the next 10, 11 years with relative low maintenance, but high impact for us in terms of the resource that we've acquired and the price that we paid. One of the key areas that we're looking to build our business in is Malaysia. And Malaysia has a host of opportunities for a small cap E&P like us. To date, we have announced a joint study with Petronas on Block 2A, which is very much off strategy for us, I must say. Our strategy, as we spoke about at the beginning, is looking at development opportunities and production opportunities with discovered resource. Here we have a big E exploration prospect in deeper water offshore Sarawak. However, what we have with Petronas is nearly 300,000 square kilometres of 3D seismic of 2016 vintage, so very high quality that was never interpreted. We've interpreted this data and we've seen some prolific opportunities within it. We're currently negotiating with Petronas to convert this into a PSC, so that should hopefully be news flow that we'll be looking to bring to the market as well. And in terms of the commercialisation of this project, this is deeper water, bigger expense, and it's not something we would advocate using Coro's balance sheet to fund. So I would expect to see us take on this PSC, work it up technically, but bring in a farming partner, and already preliminary conversations are going on in relation to such. The opportunity of commercialising this is that the Bintulu LNG plant is onshore just here. This is the world's second largest LNG plant, and if you've been reading the news in Malaysia over the last couple of months, you would probably have seen that it's facing a supply shortfall. So there is a requirement for big gas to come in there and supply the second largest LNG plant in the world, so there is a commercial market for us to address as well. What we're showing you here is some of the prospects and the surrounding leads. I think what we can take away from this is that we do have some giant structures there, and we are in an area where multi-TCF discoveries are being made. I say are being made because there was a 2 to 3 TCF discovery made back in June in not too distant territory to where we are. So it is a basin that's in play. We do know there is multi-TCF opportunities there. And the data that we've seen so far is very encouraging for us to take something on that is is off strategy for us, but still we think there's a material opportunity for Coro to play a significant part in moving this asset forward. So in conclusion, what we have in Malaysia is potentially one of Malaysia's largest undrilled structures. That's what we've identified. Gas in place is multi-TCF on our analysis. There is a commercial opportunity there to supply the LNG plant. The obstacle that we face here is that for us, the cost of this well would be beyond our current capacity, and so therefore, in order to be able to advance this, I think we would be needing to bring in a partner, or otherwise have an extremely bullish oil and gas market, which we haven't seen in a short while. So moving forward, let's talk a little bit more about Malaysia and generally the area in which we're trying to grow. A lot of M&A activity. So Repsol and Petronas, a lot of M&A activity. We saw Medco acquire Offshore Energy at the beginning of the year. Last year we saw Offshore itself acquire the Santos package. OMV are coming into Malaysia as well. And we're seeing a rotation of the majors out of Malaysia, which will present opportunity for new independents like ourselves to pick up their asset bases and establish a platform for us to grow from. As we spoke about, Repsol and Petronas had a 2 TCF discovery onshore Sumatra, Indonesia. We also mentioned about the Sarawak discovery, 2 to 3 TCF made by KUFPEC, PTTEP and Petronas. And E&I also had a discovery offshore Vietnam. So there's big discoveries still being made here, despite us being operating in mature basins. And the opportunity set for us to capture some of that is opening up. In Malaysia, we are seeing the majors rotate out. We're seeing some of the smaller independents and medium-sized companies replenish that pipeline. This is going to present opportunities for independents like ourselves. And what I really like just to finish up on is this slide, which we've taken from Petronas. So this shows that there's 173 fields with discovered resource in open acreage in Malaysia. Now that, for a small E&P like ourselves, presents a huge opportunity set because these are overlooked fallow discoveries. The barriers to entry in Malaysia are high, so they have a test in terms of your operational capability and your financial scale. We set aside both. They've also just announced the new bidding round, so that's been announced now. So there's discovered resource in there, which is ideal for us. There's exploration, and there's some work over production. So that's news flow that that's an opportunity for us to be participating in as well, and hopefully something that we can update the market on in the first half of next year as with regards to our success. So in summary, we're a small cap E&P. We have grown in Southeast Asia. We will be divesting of our Italian portfolio. That's held as a discontinued operation, having served its purpose. We've secured institutional funding from 2 current cornerstone investors who've followed their money with the second funding round that we've done. And we are continuing to uncover opportunities within Southeast Asia. I'd like to see a bit of production in the portfolio. And in terms of current news flow, we've got current drilling activity. So news flow in terms of the Maker appraisal is due imminently. Some stage, hopefully by next week, we'll have a confirmation in terms of the Tambak prospect and what we found or what we discovered or not there. In terms of Bula gas sales agreement, hopefully by the end of the calendar year, if not at some stage in Q1, and then moving to FID. And in Malaysia, you should see us hopefully convert the joint study into a PSC, participation in the discovered resource round, as well as the general BD activity that we've currently we have continually ongoing at a whole as well. So quite a lot of news flow hopefully to come in terms of operations and also in terms of new opportunity as well.
Thank you very much, Andrew Dennan of Coro. So who's got a question for Andrew? Did I see one? Yes, one at the back there, and then one in front.
CO2 removal. Would you also need to remove the nitrogen to meet the biospec?
No, nitrogen lowers the calorific value of the gas, but it's not required in terms for the spec to sell into the current buyers that we're speaking to.
Thank you.
And there's one just in front of there.
Thank you. Just a very brief question. In terms of BCF capacity, what sort of estimate would you say you have going forward? Within the whole geometry, say 5-10 years.
5-10 years. So from our perspective, we believe we're already a mid-cap in the making. On the commercialization of these 2 assets in Indonesia, we're envisaging a production plateau of 7,000 barrel BOE equivalent. So we think we're already well positioned to get to where we're going. Our aspiration is to grow the business quite similar to what James did at Salamander, towards 15 to 20,000 barrels of oil a day production. And at that stage, you should be throwing off quite healthy free cash flows. And you become very interesting then to potential acquirers. And we've seen in this area, there's a lot of M&A activity that people are acquiring it. And as we spoke of Afia, for example, acquiring Santos and then being acquired themselves by Medco. It's a path that's well trodden. So our aspirations in 5 to 10 years is to be sold to another company. But before that, we would hope to continue to increase our resource base, bring production online and grow a business that would be targeting 20,000 barrels BOE equivalent production per day.
Okay. Yes, one at the front here.
Thank you. Andy, taking into account the market's response to Tambak 2,
sorry, can you just speak into
sorry,
the mic?
taking into account the response to Tambak 2 by the markets, how are you going to deal with Tambak 1? Because I think that's a barrier. Because they're expecting results and all that. And for me, I feel confident it'll be good, taking whatever.
I think the market's cynical and probably rightly so in many regards. In terms of how it received the news flow of the first drill, I think we've been over-punished. What we proved is that the rocks are of good quality and the investment value should be enhanced. We didn't get the DST, and that's probably the cynical part of the market, saying you didn't get the DST, well, that's what we wanted. We didn't need it. It was a nice to have. It was in the program because the key risk was the quality of the reservoir. But when you're offshore, you execute your program as it was designed. So that's what we did. We had an operational issue. These things happen in life, and it's unfortunate. But we have been overly punished because what we have done is increase the resource, or believe we've strongly increased the resource size by having a successful appraisal 13.5 kilometres away from where the original discovery was made.
What would you say you've learned from that operational issue then, the whole mud capping situation?
I mean, there's not a great deal we can do. These things do happen, unfortunately, out, and it's a fact of life. You have to live with it.
And is that a risk when you go back to that area?
We don't believe so, no. We think it's an isolated incident. The well we drilled successfully. The packer was the issue, and then we ended up swabbing the well and flowed gas uncontrollably and had to put 60 barrels of kill mud down there. So, you know, it's very unfortunate. The thing that I would say is that on our initial analysis of everything that we did succeed in, we were expecting the flow rate to be at least equal, if not better, than the Mako South. So that hurts us doubly, because not only did we bring bad news, but we should have been bringing you really good news as well. So we can only just continue to get out there and educate people as to what we're doing and why we're doing it. But words like plugged and abandoned form an impression, despite the fact that it was always going to be plugged and abandoned. And language of that the market reads infers something that maybe isn't there. So it's our job to educate.
Taking into account that Timbuktu 1 is next, and we should be hearing some news very soon about that. Will that include a DST also, or?
So we have the equipment on board for that. Now, the barrier that we're going to brush up against is the weather window.
Okay.
So we're getting towards monsoon season, mid to back end of the month. So it'll be, again, a nice to have. Yeah. But let's see where we are in terms of drilling the Tambak prospect itself and the time that we have with that weather window.
Timelines between finishing Tambak 1 and the next thing you have the Bulu, right?
Yep.
What is the sort of, I'll call it dead time in between as an investor?
It's all live ongoing now, right? So we would hope perhaps maybe to bring you a first gas sales agreement on Bulu by the end of the calendar year. Drilling's currently ongoing. Perhaps maybe that'll be finished by the end of November. So there's drilling activity through November. There still is the opportunity of a gas sales agreement by the end of the year. If not, it might slip into Q1. There's BD activity that's ongoing at any moment. And yeah, that could crystallise at any point in time. And then in terms of Block 2A, which we're working on with Petronas, that could be converted into a PSC as well. And on that event, we'll be very much more vocal with regards to what we've seen in the data that we're able to show people. And that would testify towards that summary chart that I showed you in the presentation about potentially largest undrilled structure in Malaysia and multi-TCF gas in place.
So I can start my holidays in Bali very soon.
I encourage you to go Bali at any time.
Thank you.
Any more questions for Andrew? Okay, well, you can always grab him afterwards, as I hope he and all our guests will be here for the drinks afterwards. So thank you very much indeed from Coro. We're going to take you now to what's been described as the last frontier for offshore oil, sandwiched between Russia and China. Petro Matad is an explorer focusing on Mongolia, making the leap to producer, but I'm sure we're going to hear all about that. Mike Buck is a geologist, a geophysicist by profession. He spent 20 years with Lasmo through the ENI takeover. He was chief operating officer of Salamander Energy with bags of industry experience. Mike Buck.
Well, good evening, everybody. Yes, I'm the CEO of Petro Matad. I've been in post for a couple of years now. And I will assume that some of you know something about the company and some don't. So hopefully, in making a compromise of how much information I give you, I won't completely screw that up. This little map on the title slide shows you where Mongolia is. When my wife said to me, let's go on holiday to Mongolia, before I ever thought of taking a job there, I wasn't actually sure it was a country. I thought it might be part of China, but indeed it is an independent country stuck between China to the south and Russia to the north. It doesn't bound any other country, almost Kazakhstan, but not quite. And it's a very, very long way from the sea. So seriously landlocked, very large, and as you will see, quite unexplored so far. So in terms of who Petro Matad, who the company is, we were AIM listed in 2008, so long before my time. The first idea for the company came from a company in Mongolia called Petrovis, who is the largest distributor of gasoline in the country. So they have many service stations all over Mongolia, a very well-known local company. And they thought, wouldn't it be a good idea to get some acreage, nobody else seemed to be taking any, and go and explore for domestic hydrocarbons and then be able to refine and distribute domestically produced, domestically refined product. They've shown a remarkable degree of perseverance and patience, actually, because that was back in 2006 when they formed the company. 2008 it was listed, and 2019 it finally made a discovery that looks like it might be commercial. So 2020, the idea is to try and actually produce some revenue. I think if you told Petrovis that at the start, they might have said, woo, maybe we won't do that upstream bit. But there we are. We have on our board 2 members of Petrovis. Enkma is the chairperson, and Shine is a non-executive director. We also have Tim Bushell as a non-exec, who you may know from his time in Falklands Oil and Gas. I joined the company, as I said, two years ago. I'd worked with Tim some years ago in Lasmo, and John Henriksen, the Chief Financial Officer, has been in the company for 7 years. This is the 3rd time that John and I have worked together, so we've got some familiarity amongst us on the board, and some experience of finding oil and gas and trying to commercialize it. Now, in terms of why we're in Mongolia at all, this map summarizes, at least in schematic form, what happens when a country doesn't explore for its hydrocarbons when the rest of the world is doing so. So Mongolia, for most of the 20th century, was a satellite of the Soviet Union, and the Soviet Union didn't explore for oil in Mongolia, had no need to, had no reason to. It had plenty of oil close to its population centers further to the west. The only oil field that they developed was a very small surface anticline that was seeping oil at surface, so it wasn't great exploration that led them to it, but they did that for military reasons in case they had a war with China. So that field has been in production since the 40s and is still in production now, but it hasn't produced very much. That's in... that doesn't seem to work. Let's try it another way around. No, battery's flat. So anyway, it's in the East Gobi Basin in the southeast of the country. And then when the Soviet Union fell, and companies like BP sent their geologists... Thank you. Which one, the red one? Yeah, just the top. Thanks. Okay, so that's where that Soviet field is. So when the Soviet Union fell, BP and some other big boys sent in their geologists. They looked at the petroleum systems that could be present in these yellow basins, these undrilled basins in Mongolia, and noted that it was exactly the same geology as the basins of northern China. And China was exploring its own basins through the 20th century, finding multi-billion barrel accumulations and starting to produce. Those fields are now in decline. But Mongolia didn't get that kind of exploration attention, and even then in the mid-90s, BP and others didn't rush in because, as I said, landlocked country stuck between 2 global superpowers. If you find something, who's going to buy it and how much they're going to pay? So that was a problem that kept everybody, I think, shy. The only people that had the steel to go after this was SOCO. SOCO moved in to this area of Mongolia, an extension of the Hilar-Tamsag Basin from China. So they followed the geology in there, they drilled some wells, they found some oil, they put it on stream at a relatively low rate, and then in 2005 they sold that asset to Petrochina. And Petrochina came in and drilled many hundreds of wells, got the production up to 25,000 barrels a day, and they are still the major producer in Mongolia. So 95% of Mongolia's current production comes from those fields. The rest comes from the Sinopec-operated old Soviet field here. All of that oil is exported to China as crude and is refined in China, and nothing comes back as product. Mongolia has to buy product from Russia, and therefore the Russians have a monopoly, and so the price is high. The Mongolian government would like nothing more than some energy independence in terms of oil and gas, so it has tried to incentivize people to come in by offering good fiscal terms. It can't do anything about its geography, though, and I think what some of the big boys have been waiting for is somebody to make a big discovery or to have a big flow rate and to attract some attention. The only company that's been active in exploration over the last couple of years is Petro Matad. We are a small cap company, so we obviously don't have the financial firepower to just go completely wild in the West and wildcat all over it and see what we can find. But we've done our best over the last 2 years to find some oil, and I'll just summarize where we've got to in the program that we have done. But before I do that, a little update on the oil industry itself. This is the production chart for Mongolia, peaking at 25,000 barrels a day or thereabouts in 2015, in decline now. That's the natural decline of the Petrochina fields. They claim to have some resource already discovered, not yet produced, but we're not sure that that is going to reverse this decline. It might decelerate it a little bit. But meanwhile, Mongolia has decided, as part of its energy independence, to build a refinery, which is going to be located here on the main rail and road link between the capital Ulaanbaatar and the Chinese border. They're building a refinery using a soft loan from the Indian Exim Bank of what was $1 billion, is now $1.3 billion, and they've actually started to spend that money. The feedstock required for that refinery is 30,000 barrels a day. So by the time it's ready in 3 or 4 years' time, Petrochina's production will probably be able to satisfy about half of that. So Mongolia really wants people to find some oil. And so they were delighted when we recently announced that we had found some. It's not all by itself going to fill the 50% requirement to get up to 30,000 barrel a day feedstock in one jump. But it has been viewed very positively by the government, and I'll talk you through that next. We did recently receive an award as the leading explorer in Mongolia, but that's from a field of one, so we can't really claim too much credit for that. So we raised money in 2018 to drill what we said was going to be a multi-well program of exploration wells. In 2018, at least early 2018, the market was open to the word exploration. Not sure it is now. We have now completed that program. We drilled 5 wells and we tested 1. We found oil in 2. We've registered 2 discoveries, 1 rather small, but the Heron discovery looks like it's going to be commercial, and it did deliver a good flow rate, and I'll talk you through that. The big wells we drilled in the west, one was pretty comprehensively dry. The other one had good oil shows within it, proving the petroleum system, but didn't have a commercial accumulation at that location. So let's have a look at what we were doing through 2019. And this was in Block 20, which is in the east of the country, immediately next door to where Petrochina produces its oil. So this is a map of Block 20, which is 10,000 square kilometers, which is quite a lot of acreage for a company of our market cap to try and explore. And when you add to it the 2 blocks of 50,000 square kilometers in the west, you can see that we did have our work cut out to decide where to drill within these huge blocks. But anyway, in block 20, we'd identified basins with gravity data and with some seismic, and we drilled 3 wells in 2019. Red Deer number 1 was the first ever well drilled in this basin, which is called the Asgat Sag. We found quite good oil shows in the well, but no commercial accumulation. It does highlight that there may be some more potential down here. We drilled Heron 1 and then Gazelle 1 right up in the north, adjacent to the producing fields of Petrochina's Block 19. Now, our exploration period for Block 20 actually ends in July of 2020. So these wells were being drilled in the final year of the exploration term. Under the petroleum law, there are no more extensions that can be requested for the exploration period. So the only way to hold acreage beyond July of next year is through the granting of an exploitation license. And to do that, you have to find something. So our work was cut out to do that. So with Heron was our best chance of success because we shamelessly located it as close to somebody else's oil field as we could possibly get it. So here in Block 19, this is the block boundary between Petrochina's Block 19 to the north and our Block 20 to the south. In here, there's a field called 1946. This part of the field has been developed over the years. These wells were drilled about 10 years ago. They've had a couple of, as far as we can tell, a couple of appraisal/development wells drilled, but never put into commercial production. We think that was because they didn't want to let on to us that there was actually an oil field that they mapped as extending into our block, hoped that we'd finally give up and they could just have it for free. So we drilled Heron here as an appraisal of this overall structure, and it came in and proved that indeed this is one structure, a total oil field area of about 21 square kilometers, 62% of which lies on our block, and the structural crest is also on our block. We assessed pre-drill that there was probably 25 million barrels of recoverable resource in the Heron structure on the Block 20 acreage. That's using parameters that Petrochina are able to sustain in their block to the north, which includes things like a 15% recovery factor. We hope we'll do better than that. And we did get a good test result that suggested that indeed we may have been a little bit conservative. But 25 million barrels will be very, very commercial in this area. The well itself flowed at, excuse me, I'm just getting a, a little bit of a tickle. The well itself flowed on DST at an initial production rate of 821 barrels a day, which is about the third best well in the basin. And so we were very pleased with that. It also flowed to surface naturally, which many of these wells do not. So that was a good result, but it is only an initial production rate. We were only able to test for about 2.5 days. So the sustainability of that production still needs to be determined, but a very good result. And we've also mapped within the area we hope to retain as our exploitation license a number of structures that have resource potential of 50 to 85 million barrels. So this could be a very good exploitation license to have. And we have the rapid commercialization potential of Heron. It is located here in Block 20 kilometers to the south of Petrochina's facilities. Petrochina have already said they will welcome us in, and we will be looking to do a commercial negotiation with them over the next few months to see what kind of terms they would offer for us to put our oil through their infrastructure. We will also be producing the Mongolian government share of production from Block 20, so we expect the Mongolian government to be on our side in that negotiation. So in terms of the provisional work programme for 2020, this is a very different work programme to the ones that Petro Matad would have had for all its previous years, where we were solely focused on exploration. Here, our primary goal right now is to secure that exploitation license. We've shown it on here taking until the end of the first quarter. I've told the government I'd like it before the end of the year. They didn't throw me out, but they did have a look on their face like, you're joking, right? I would be satisfied with the end of the first quarter because in parallel we are already doing the permitting that is needed in Mongolia to be able to put this field into production. And then our plan would be, I don't want 2020 to be a wasted year, our plan would be to get Heron 1 on production by the middle of 2020 and to start earning some revenue, finally, and also to be able to drill Heron 2, Heron 3 and Heron 4 on locations we've already chosen based on the 3D seismic that we have in this area, good quality and therefore easy to define these appraisal locations. So that would be our provisional work programme for 2020, focusing for the first time in the company's history on getting some revenue generated. Now, in terms of the value of what we found, if this really is 25 million barrels, if it was in the hands of Petrochina, they would apply their usual parameters, say, oh, 25 million barrels, we recover about 300,000 barrels per well, we'll need about 60 wells, but we can drill them for $1 million each. The NPV 10 of that is about $150 million. It shouldn't have BO on the end there, sorry, with a rate of return of 36%. That is perhaps how Petrochina might value this. And that's good, and I'm going to push that because when we go to talk to Petrochina about the possibility of using their facilities, we expect also to be talking about the possibility of partnering. They've already offered their services to us because they reckon they can drill cheaper than anybody else, and I think they're right. But what we would say to them is, hey, why don't you farm in? Why don't you pay something for a working interest in this, bearing in mind that what we've found is already quite valuable, and there's that upside that's 2 or 3 times the size that you shouldn't forget about. Now, there is a good possibility that Petrochina may want to join in here from the things they've said in the past, but we have also looked at the possibility of a self-sustaining early production system that we could fund ourselves without the need for a big equity injection. We'd need a little bit of Kickstart money, $10 to $15 million that we currently don't have. That $35 million we raised last year, we've spent, by the end of this year, we'll have spent all but 3. So we have enough money to run the company to get ourselves the exploitation license and actually to put Heron 1 on stream. But with this injection of capital, we'd be able to get that well on stream, get Heron 2 drilled and on stream, Heron 3 drilled and on stream. Because of the favourable fiscal terms here, we're able to pay for our office overhead and all our production and operating needs with around about $3 to $3.5 million for a year of operation. And for that, if we're producing 350 barrels a day, then we would be able to cover our overhead. And if we've got 4 wells on production, each doing somewhere around 300 barrels a day, we're producing 1,200 barrels a day, we're actually making quite a bit of money. So it becomes cash positive quite quickly in year 2, and that would enable us to drill more wells without having to raise any more than this $10 to $15 million. And for that $10 to $15 million, I don't really want to do it as equity. It probably wouldn't be that easy at the moment. We're talking to the Mongolian banks about the possibility of debt financing for some of this. It's a little bit too premature for the international banks, and it's also in Mongolia, and so they'd have to overcome their concerns about country entry. The Mongolian banks don't have that problem, and they're very keen to see indigenous Mongolian production brought on stream. So we're having that conversation. We've also spoken to logistics companies that are involved in the mining industry in Mongolia. These guys would pay advance payments for a long contract as the off-taker. One of them that we've spoken to, they would like to transport the oil to Russia, which is something new. And so we could get some money from them to finance the kickstart of the early production system. So this wouldn't all have to come from basically from shareholders as an equity raise, and that's what we're focusing on. The possibility to become cash positive as quickly as we can, generate some disposable revenue, develop the field. It doesn't maximize the NPV of the asset. Doing it the way Petrochina would probably does that, but actually from a shareholder point of view, doing it that way is probably better in terms of what it would do for the share price. And we are also looking, in parallel with all this, at refreshing our exploration thesis for Mongolia, which is the thing that we've been doing for so long. We're talking to some of the big Western companies that are actually actively exploring around the world and using their own balance sheet to do it, because those areas of Western Mongolia are so large and the blocks are so large, you actually do need quite a lot of financial firepower to be able to do the job properly. I believe that there is commercially recoverable hydrocarbons in quite large quantities in Western Mongolia. It just needs somebody with that amount of financial firepower to get after it. So if we could introduce one of the big boys as a partner of ours to come in and largely fund that program, they could get, for a $75 million exploration investment, they could get high resolution gravity, they could get a lot of seismic, including 3D, and we could probably drill 6 wells. Whereas, currently they're spending $75 million on 1 well offshore. So being the last remaining onshore frontier, we think may be attractive to some of these guys. In the farm outs we've done over the last few years, or attempted to do, there has been some interest from the big boys. I think technically some of those companies believe in the possibility of Western Mongolia and its upside, and we're offering them a way of a soft country entry in that we will be their operator and they will be our joint venture partner. So that kind of restocks the exploration hopper for us if we're able to do it, and we're trying to have those discussions right now. Meanwhile, we still hold 2 blocks in Western Mongolia, and we haven't given up on the potential of those, although we did drill 1 well in each block last year. This was one of those wells. This is Snow Leopard number 1, which was drilled in block 5 in western central Mongolia. This well found had oil in the mud, and quite a lot of oil in the mud when it was drilling through shales, proving a working petroleum system in the basin. But unfortunately, the sandstone reservoirs that we were chasing, one of them was not there. The deeper one was present, but didn't have any oil in it. The oil play fairway seems to be shallower in the basin. We like this basin because we've proved the petroleum system, and that's this one here, the Tats Basin, and that's where Snow Leopard was located. And we have some shallower prospects just to the south on what we call the Raptor trend, 3 or possibly 4 culminations, anticlines, that we could drill with a small rig at very low cost, and we would like to do that. And over here there's a similar basin, the Tugrug Basin, in which we have a 3D seismic survey that has identified the Fox prospect that we identified a couple of years ago. Now we have a shallow 4-way dip closure over the top of Fox, which we could reach with a small rig. And we have the Phoenix prospect, or a cluster of prospects in this area. Velociraptor, which would be the main target down here, has 200 million barrels of resource potential. Phoenix has 230. Fox shallow has about 40. So there's 500 million barrels in 3 individual features over here. But this is wildcat exploration. I'd like to do it cheaply, and I'd prefer to do it with revenue that we had earned rather than had to raise. So we are talking to the government about buying ourselves a little bit more time on Block 5 to keep it in the portfolio. So the conclusions, I don't need to go through all of these, but we've completed our program. We've made a discovery. We're looking to get that on stream as quickly as possible. We're looking to use revenue from that to fund the further development of that field, or we'll partner with Petrochina or some other third parties that we are likely to talk to. And we have not yet given up on the wildcat exploration, but we would like to do that for a long period in partnership with companies that don't need to raise equity every time they want to drill a well. So with that, I will close. Thank you very much.
Thank you. So the final frontier, probably more Star Trek than Thunderbirds, we talked about earlier. Questions then, we've got time for a couple. Yes, got one over there.
Thanks, Mike. Interesting presentation. Congratulations on the Heron 1 discovery.
Thank you.
My question is, there was never any requirement to unitize, because it's clearly one field.
Yeah. There is a unitization regulation in Mongolia, and the Mongolians in 2016 tried to impose it on Petrochina. There's another feature that crosses the block boundary with our block, feature called 1962. So the authorities shut down Petrochina's production and said, go and unitize it with Petro Matad. So data was swapped, meetings were had, and then Petrochina said exactly what I would say: prove it, prove that you've got some, and then we can talk, because we hadn't drilled our side of that feature. Here we have drilled our side of the feature now, and I think we've proven pretty conclusively that it is the same feature. But what Mongolia realized whilst it was having the conversation on the other field was, we don't want to shut it down because that stops our revenue. So they came up with the pragmatic solution of nobody can drill within 250 meters of the block boundary. So long as you don't do that, you can carry on, you can drill, you can produce, and get on with unitizing later.
Okay, thank you.
Yep, question at the back. Oh, thought there was. Okay, let me just ask you, you mentioned obviously the location here, Russia. We know about Russia's proclivities sometimes for interfering in countries. Just briefly, who runs Mongolia, and where do China and Russia make their influence felt, and could that ever upset your plans?
Yeah, I don't think so. I think Mongolia is now a pretty stable republic, and has got 20 plus years behind it. But it started its life very, very Russia focused, because actually the Mongolians to some extent missed the Russians. They reckon that the Russians did a good thing and organized lots of stuff, and when they said they were going to do something, they did something. But they've become, as a country, a lot more China focused, because most of their trade is now with China. The Mongolians as a race don't particularly like the Chinese, and it seems to be mutual, but they've become their major trading partner. So whilst the older generation of Mongolians speak Russian as a second language, the younger generation speak Chinese. So it's a little bit of a schizophrenic relationship that they're having at the moment. But in terms of the overall governmental relations between the countries, they do seem to be quite close. They have good ties. There doesn't seem to be that much in the way of interference. You know, we talked to the Mongolians, the amount of Chinese interference over the years has been just terrible. Now it's just gradually taking over absolutely every piece of business that they do. They don't really like the idea that the oil industry seems to be entirely in the hands of the Chinese. So the fact that we, a Mongolian company, as Mongolia looks upon us, has made a discovery, that's really quite positive for them. But no, I don't think on a super global scale, no, I don't see a threat.
Great, thank you. Any more questions? Just one here.
It's a very brief question. I think you mentioned that you actually expecting 2020. I think you said the second half. You expecting a production. So in terms of how say confident are you in terms of things coming on stream, whereby the returns will be able to run some of the other wells, so that you don't need someone to come on site? What's the percentage sort of?
I think the risk around delay to starting up the production on Heron 1 and finding out what it will do on a sustainable basis, that just comes down to the speed with which we can get the exploitation license. Mongolia hasn't awarded one for many years because nobody's asked for one for many years. Nobody's made a discovery for many years. So it's actually just making sure that bureaucracy can move. So we're trying to use the euphoria and the momentum we've got behind the Mongolian company right now to get the government moving to say, until we've got tenure to that land, there's nothing really we can do apart from permitting. So please give us that quickly. So I think that's my main question mark. But I've asked them to do it quickly, and all indications are that they are going to do so. In terms of putting one well on stream and using the revenue from that to fund the next well and the next well, that would be quite slow. That's why we need 10 to 15 million to get the thing moving. I don't want to do it all through equity, but we need that to get things moving. That way the cash pile builds faster and could finance a development drilling campaign every year. But if it was just coming from the one well, that well would have to be highly productive for a long time, and even then it would be a slow build-up of cash.
Okay, thank you very much indeed.
Thank you.
Mike Buck from Petro Matad. Well, we move to our final speaker now, and we're turning to Eco Atlantic, an oil and gas explorer which is focused on acquiring and developing unique upstream petroleum opportunities, notably so far in Guyana and Namibia. I'm sure he'll tell us all about that. And prior to co-founding Eco Atlantic Oil and Gas, Gil Holzman was co-founder of GP Minerals Limited and is a past MD of Bombardier's Middle East region. So let's hear it for Gil Holzman, co-founder and chief of Eco Atlantic.
Thank you very much. Hi, good evening. Thank you very much, Nigel. Thank you very much, Donald, Phil, for inviting me. It's an honor to be here. Some of the faces I recognize, some I don't. Probably I only know your nicknames at the bull boards. We are 25 minutes away from the drinks and canopies, so I will try to be very, very short. I will be quite surprised if some of you never heard of Eco Atlantic. Eco Atlantic is a small oil and gas exploration company with a very clear strategic model. We come into what we believe to be prospective oil provinces across the Atlantic margin. We come in quite early into underexplored region. We prefer English-speaking countries, and we always take a very large I need to drive this? Ah, I didn't know that. Sorry. And we always try to take a very large working interest, or very large blocks to start with, under a strategy that eventually we de-risk it internally using our own financial resources and our own technical in-house people to a stage that it is mature enough to bring in bigger companies to help us carry on the heavy load of the work program. We use their their bigger technical horsepower and their additional financial resources. We currently have 5 oil exploration blocks, one in North South America in Guyana, and 4 in Namibia. Guyana is, to those of you who still don't know Guyana is the host of the biggest oil discoveries in the past 2 decades, with over 6.5 billion barrels discovered by ExxonMobil and Hess and Sinuk in the past 4 years. So this is our block in Guyana, our Rindwick block. Over there we partners with Tullow Oil. Some of you probably heard of them. It's a small English company. And Total, which is the French super major, recently sold a stake to Qatar Petroleum, waiting for them to come into the block as well. So it's us, the big echo, alongside the Tullow, Total, and Qatar Petroleum of the world. There's a pointer here? There is. This is our block. This is the famous Starbuck block. As I said, 14 oil discoveries in the past 4 years with 6.5 billion barrels of recoverable oil made by Exxon. This is the block. These are all discoveries. The green areas are all big discoveries made by Exxon in the past 4 years. As I said, first was the Liza discovery, then the entire Turbo area, and lately Hammerhead, which actually extends into our block. Our block is the one that is marked in light blue, where we actually started our exploration program earlier this year in July, and came up with two oil discoveries, the Jeffro one and the Joe one. Jeffro one was drilled was announced as an oil discovery in August this year, and Joe one was announced as an oil discovery in September this year. So basically we drilled 2 wells and we have 2 oil discoveries. Actually, we have a third discovery, which is an extension of this discovery made by Exxon, which extends into our block. So we are probably the only company in the business that has 167% hit rate. We drilled 2 wells and we have 3 discoveries on our block. That's again the Jethro and Joe discoveries. They are all located in the north part of the block. The block is marked here. All of the oil in Guyana is to be found on the slope. There are 4 distinct terraces or water depth levels on the slope from the continental shelf and down into the deeps. The Exxon discoveries were made at the 4th slope, what we call it, 1,500 meters water depth. The Jeffro and Hammerhead discovery, the same discovery that extends into our block, were made in the 1,350 meters water depth. Joe discovery was made in the second terrace at 650 meter water depth. And currently there's another well being drilled by Repsol, Total, and Tullow, which they call Karapa, which targeting over 300 million barrels of a prospect that is being drilled on the shallow water shelf, that's 70 meters of water. Let me show you how it looks like from the side. So Hammerhead discovery made by Exxon back in August 2018 was drilled here. This is the block boundary, so if I would put a straight line over here, you see that some of the oil actually goes into our block. Then we went and drilled Jeffro back in July 2019, so a few months ago, and came up with a big discovery. Actually, we exceeded our pre-drill expectations, and we came up with a thicker reservoir than expected. Then we moved the drill ship and drilled the Joe discovery, announced in September this year, and currently Karapa is being drilled as we speak right now. It was spudded 2 weeks ago, and we expect to have results by the end of November, beginning of December. All in all, what's that? All in all, and just to give you again a look at, this is our block. You can see 1, 2, 3, 4, 5, 6, 7, 8. Trust me, there are 20 prospects over here. All in all, we believe that our 20 prospects could contain around up to 4 billion barrels of oil, out of which we have we are 15% working interest on the block, so out of which we will potentially end up with 600 million barrels worth of oil. 1 barrel of oil in the ground in Guyana is estimated to value $8. There are all kinds of numbers going around, but it's anything between $7 to $10 NPV today for a discovered oil. So if we can tap the full potential that we believe we have there, 600 million barrels times $8, $7, $5, $2, it doesn't really matter, means that we will potentially be a very, very big company after an extensive exploration campaign that is due to continue in 2020 and 2021 and onwards. This is, as I said, this is a world-class basin, the best hit rate in the entire oil world. Exxon drilled 16 wells and come up with 14 discoveries. As I said, amount to more than 6.5 billion barrels. So basically, every well that they drilled, over 90% hit rate. Every well that they drilled actually encountered oil and in big quantities. We drilled 2 wells, and we have 2 discoveries, so our hit rate is 100%. And you know, people consider Guyana to be one big pool full of oil that's like fish, like shooting fish in a barrel. Wherever you drill, you find a pocket full of oil. This is remarkable. The first discovery was made in 2015, the Liza discovery, and in 3 weeks from now, exactly 3 weeks from now, it will start producing at a rate of 125,000 barrels a day, ramping it up to 1 million barrels a day using 6 FPSO by 2025. As I said, yes, over 6 million barrels. You all have this presentation. These are all the discoveries with the net, with the thickness, with the net oil, etc., over 9.5 billion barrels discovered, 6.5 recoverable. We also have additional 4 exploration blocks in the second hottest exploration area in the world. Actually, if it wasn't for Guyana, Namibia was the number 1. I'm a very, very big fan and a true believer in Namibia. Offshore Namibia, West Africa, Southwest Africa. We entered the space in 2011. Back then, more than 75% of the blocks were still up for grab. They're still open. In order for us, Namibia is, you know, it's has one of the longest coastlines in the world per country. It's 1,600 kilometers, and in turn, the area of the economical water for oil exploration is huge. When we entered in 2011, we were one of the first movers into Namibia, so we could pick from everything that was available in order for us to know exactly what we're picking and to try and reduce our selection. We came to a deal with the Namibian government, according to which we will carry NAMCOR, the National Oil Corporation, for 10% on our exploration activities, and in return they will let us review all the data that was then available. So we spent three months in the NAMCOR in front of the one working station that they had back then, and we picked 4 offshore blocks in the Wallabies Basin that we believed to be the oil kitchen of Namibia. Namibia has 4 sub-basins: the Orange to the south, Luderitz here in the center, Wallabies here in the north, and north in the Wallabies Ridge towards Angola. There's another small basin. So we picked 4 offshore exploration licenses. We started the work back in 2012 by acquiring the existing 2D den. We brought in Tullow and Azinam as partners. So Tullow was our partner in Namibia as well back in 2013, and then we shot a few surveys of proprietary 3D, which brought us to a position that we now have, as I said, the 4 blocks offshore Namibia. 2 of them are drill ready, covered with 3D and with target already selected. We still have time. On our fuse for our drilling campaign. We believe that we will probably be drilling Namibia in 2021. Until then, and what happened in between is that, as I said, we started with very small companies ourselves, and Impact and Pancontinental, some of the names you probably know here from the market, Chariot, but in the past 2-3 years, mainly 2 years, the big boys of the oil exploration world came in, and now we have Shell, Total, Exxon, Cosmos, Galp, Africa Oil, More and Prom, all active in the region, and we are expecting 4 wells to be drilled starting April. Offshore Namibia, the first well will be drilled by Total right here. It is targeting 2 billion barrels of oil in the Orange Basin. The second well will be drilled right here, right next to our 3 blocks. This is a second well that is going to be drilled in May. And Exxon took lately 5 blocks, 1 in the middle of us, and 4 up here. They're planning to drill by the end of the year. So in Namibia, in Guyana, we have Exxon as our neighbors. This is not bad neighbors to have. They follow us everywhere, actually. Some of the portfolio highlights, again, you have it all back there. So in a nutshell, our approach is we have a proven strategy of coming in early, taking a very large working interest to start with in underexplored prospective basins, English-speaking across the Atlantic margin. Then we partner with what we believe to be the best in the industry. We are, again, a small company, but we have Total as a partner, we have Tullow Oil as a partner, Qatar Petroleum as a partner. These kind of partners enable you, first of all, to add a lot more technical horsepower into every decision, into every technical meeting, as well as benefiting from their very deep pockets, and we try to strike deals that are fair for both sides, and they do carry us for a lot of the work. This is how we de-risk our shareholders' valuable money, and this is how we de-risk the play technically. Some would say we have a very good management. We are focusing on highly prospective areas, and we have a unique exposure to Guyana, which is considered by far in the entire exploration world to be the hottest area in the world. Some of the partners that we have, Africa Oil is our biggest shareholder. You know Africa Oil, probably you heard of Africa Oil. It's a part of the Lundin Group. Africa Oil is headed by Keith Hill. Keith Hill is a veteran and very experienced explorer and producer in the industry. They own 18.5% of Eco Atlantic as a strategic partnership. So in turn, we can always go and say to big boys that negotiating with us that we have Lundin as a grandfather, and they don't want to mess with our grandfather. As I said, other partners are Tullow Oil that you know, Total, Azinam, and Namco. This is our board and management. I don't want to waste your time. You have it in your presentations. And the investment case, we drilled 2 wells this year with 2 discoveries. This is only the beginning of what could be a potentially one of the biggest blocks in the exploration world. We have a potential for 4 billion barrels. We only tapped less than 8% of it at the moment. There's a lot more, many more prospects to come. We have Tullow and Total as partners, very keen partners. We are planning a 2020 drilling campaign with at least 2 wells, if not more, to be drilled starting before the middle of the year. We have Namibia as a pure upside potential with 4 wells being drilled in Namibia this year, in adjacent to our blocks that could open whole new plays in the region and will bring in additional very big players. And we did well this year in terms of return to shareholders, but that's the #1 strategy that I always carry. It's nice to have oil, it's nice to find oil, it's very nice to find oil. It's nice to produce oil, but my main goal always is to create shareholders' value. And my board and myself will always take decisions that will maximize shareholders' value. So we're not in love with any of our assets as long that we know how to make very, very big returns to our shareholders. That's it.
So, questions for Gil Holzman before we finish? And we've immediately got one over here.
Hello, Gil. Thank you for that. Neil Pigeon from Keith Bailey Rogers. In Namibia, and you're going to have to correct me because my memory's fading a bit, but did Chariot not try and drill a well which came in as a duster about 3 or 4 years ago? So it's interesting to know why, and then why was Namibia not favoured before, and what's brought everybody back, and what do you see in it compared to, say, Guyana, and why is everybody coming back to the area?
In terms of what's working or not working in Namibia, Namibia, and those of us who follow it for the past 10 years, Namibia have seen few eras of peaks of exploration. Started in 2011 with, back then, the Chariot first well, which was up north in the Namibia Basin. That didn't work. Paul Welsh drilled it, and unfortunately what they thought to be carbonate reef was actually basalith, was volcanic shows. Then in 2013, you had the famous HRT campaign. HRT actually did recover oil to surface at 42 API. Very good quality oil right in the middle of the Walvis Basin. They proved two source rock, the Aptian and Albion, but not in commercial quantities. Then after their failing campaign, 3 wells that back then cost around $300 million. The industry went into the downturn in 2014. There was no one to drill offshore Namibia, and we had 2 attempts to drill in 2018. One is Chariot, the second one is Tallow. The good thing about these wells, they cost less than $19 million per well, gross, the entire well. So 20 days worth of a well, $19 million. So if you have 20% working interest, this is very affordable. The problem with both wells, as much as I know, and I'm not a technical guy, the problem with both wells that the reservoir, the deemed reservoir, was too far away from the source rock. So it was 300 meters or 400 meters above the source rock instead of few meters or 50, 60 meters above. It did encounter hydrocarbon shows, some wet gas, things like that, that suggest that there's a petroleum system in place. The one thing that now changed Namibia, and that's what makes all the big boys coming into the region, is a new geological theory that was proved by the Brulpadda well in South Africa. There was a very famous well drilled in December 2018 by Total and Africa Energy as partners. Africa Energy is a part of the Lundin Group. And they discovered equivalent of 1 billion barrels of gas condensate offshore South Africa in the Durban area. Not Durban, I don't remember the name, but in the south, no, not in Cape Town. In any case, that proved a Syn Rift petroleum system, which by then no one considered Syn Rift to generate oil over there. It's much older and much deeper, but they proved that it works. And now everyone is eyeing the entire west coast of Africa, especially the South Africa, Namibia, and Angola, for Syn Rift kind of plays. We have a lot of Syn Rift, naturally, it's deeper in Namibia, and the big boys, Exxon, Total, Shell, Cosmos, Qatar Petroleum, that came into the country lately, they are all targeting this new geological theory. Total are going to drill the deepest well ever drilled in West Africa in April, targeting 2 billion barrels of oil into this Syn Rift, and we all hope that they will be successful. One thing I can tell you about the difference between Chariot or ourselves or even Tallow, until 2 years ago, Namibia was, and this is why it failed eventually. Namibia was what I call a country of one well companies. So companies like us, we can afford ourselves to drill one wildcat offshore Namibia. If it works, great. If it doesn't work, you're either out of business or out of money or out of the country or both. Exxon is not like that. Exxon can spend a lot of money on, first of all, on science and on trying to understand the broader geological structure of the basin. Same as Total, same as Shell. They came there to properly explore. So it will take a year, it will take 2 years. Eventually, they will crack the code, and they will be able to prove the oil offshore Namibia. I'm a very firm believer that in 2 years from now, we'll see first oil in Namibia.
Thank you very much. And just following on from that, did you say it's $20 million a well now? 19 to $20 million?
That was the Chariot well, $20 million.
Okay. And would you seek farm-out partners for that?
Sorry?
Would you seek farm-out partners for that, or would you
As I said, our strategy is to take a large working interest to start with. We will end up with very comfortably with 15, 20, 25%. Yeah. We don't drill wildcats at 60% working interest.
Okay, thank you.
There's a question at the back.
Hi. In Guyana, how much a risk is the election next year, do you see, that's coming up?
To whom? To the
To you,
politicians?
and your activities.
I'm not running for election, so there's no risk for me. First of all, the oil that was found in Guyana, or the proceeds from the oil, has the power to recreate a nation. And they're recreating a nation from, it's a very poor country, one of the poorest in South America, $4,000 GDP per capita a year, and they're going to become the richest, by far the richest country per capita in the world in 5 years from now. So it has a huge impact on the entire population. There's an opportunity of a lifetime for a nation to actually benefit from such a boom, economical boom, and they need to take very smart measures in order to make sure that they manage it properly. So any government that will come into power will be pro-oil, meaning they will let the professionals do what they do, they will collect the money, and they will invest it in healthcare and education and infrastructure to rebuild a nation. This is one. So I don't, regardless who is going to be voted, he's going to be pro-oil. They will try as a campaign measures to try and, to nick some more royalties. That's always the case, but that's for campaign purposes. Any government that will be elected will be pro-oil. On top of that, the challenge is so big to manage this huge wealth coming from the oil that is starting to flow as of 3 weeks from now, that there are many, many calls for unity government, because the nation needs to come together in order to, as I said, to recreate itself and to become the next Norway or the next Qatar.
Any more questions? One more, two, all right. Two, make them fairly quick because we're getting to the end of our time, but we'll try and squeeze you both in.
Thanks, Gil. Fast forward 3 to 5 years when hopefully you've proved up a lot of your reserves and you're sitting on 15% of a huge amount of oil. Do you see yourselves, I can't see you becoming operators with 15%, do you see yourselves as a production company or will you seek to monetize your assets?
I look very bad in helmets. Honestly, I tried a few times. We know what we know to do best. We know how to generate good licenses. We know how to attract good partners. We know how to explore. We know how to create shareholders' value. This is why we're here. I don't see myself producing oil for the next 25 years, sitting on a rig somewhere in the middle of the ocean offshore Guyana. That's not our business. Our business is to create the biggest shareholders' value as we can, and the board will seek all alternatives to make sure that we monetize our discoveries in the best manner. Again, to answer your question, I don't think we will have an Eco-Atlantic in 5 years.
Okay, so that's no. Over here.
I said I don't think so.
Very good presentation. What about your drilling next year in Guyana? You've got these 3 wells. Can you tell us, I'll turn the cameras off, but can you tell us what targets you're going to drill and how are you keeping Tullow focused? Because they've got lots of wells elsewhere. I don't seem to have your focus for Guyana, and it's a bit strange.
Great question. Thank you very much for that. First of all, it's not a question of focus. They are focused on Guyana. I think that the Guyana is the number one priority on their portfolio. That's for sure. But they have commitments as well. If they don't drill a well in Peru, they will lose the license. And this is how it works. So they need to manage their limited exploration budget, and they have a limited exploration budget because of all kinds of other issues that they have in the most proper manner. I didn't say we're going to drill 3 wells. I wish we would drill 4. We have money for maybe 6 even. But the bottleneck will be Tullow's priorities. They do need to drill a well in Peru. They do need to drill a well in Suriname. In terms of target selections, we will... There's a parallel. There's an effort in parallel. At the moment, they drill Karapa. Okay, they will not select any target for next year or Windwick block before they have the results from Karapa. By the way, every day that goes by and we hear nothing about Karapa is a good sign, because when you have a discovery, it takes much longer to log and to sample and to test. If you have a duster, you announce a duster immediately. Let's hope they will say nothing in the next 3-4 weeks. Once they have results from Karapa, we will go back to the drawing table. We will reprocess our entire 3D seismic with the well logs from Karapa, from Jeffro, from Joe, to come up with the target selection from next year. there are different views around the table. For example, Total would definitely like to go for the biggest target. They would like to accumulate reserves. This is their business. Tullow would like to test Jeffro or to appraise Jeffro potentially in order to come up with a potential production seam and to test the Jeffro channel that goes into the Jeffro lobe discovery. We would like to come up with a few more discoveries just to make our shareholders happy. So we would like to, to target the low-hanging fruits that we see there. In any case, the market can expect a new CPR from us that is being now reviewed and updated potentially in the next 3-4 weeks. I think this CPR will be a roadmap, at least from Echo's perspective, of what needs to be drilled next. But the joint venture, as a joint venture, will be able to decide and announce drilling budget and targets by January, I think.
That's not going to be too late for Tullow's budget process.
The budget is the budget. They have around $150 million for exploration. They need to drill a few wells next year, so.
Okay, well, we'll have to get Tullow here to answer to that question themselves. Thank you very much indeed to Gil Holzman. Thank you. Well, I think you'll all agree, ladies and gentlemen, we've had some terrific companies tonight. We've had 4 chiefs with a lot of knowledge about all the detail of their companies, so thank you very much. This is our last event before Christmas, so if I don't see you again, happy Christmas, prosperous New Year. We'll see you back in the New Year. Please, while you're waiting in the queue for food, please fill in your survey forms. Bit of feedback, both for LSE and for the companies. Thank you very much indeed.